Yeah, so we are officially we're 50% through. We are 50% through this course. So I'm hoping that all of you guys have really seen a difference in your knowledge when it comes to trading. And I'm also hoping, more importantly, that you guys have actually started to at least test this analysis on your charts. And whether it's through Vantage or whether it's through TradingView, it's very important that you guys apply everything that I'm teaching you because that's the only way in which you're going to learn. So for today's session, it's going to be the same format, but I will require all of you to unmute your phones or your speakers at some point because I will be asking questions. I've been doing quite a lot of talking over the last few weeks, and this week in particular, and going forward, I want to make sure that it's a lot more interactive, and I really want to hear and understand and just kind of confirm if you guys have actually understood and you're very clear with how the markets work, whether it may be fundamentals, technicals, or the psychological aspects of trading as well. So be prepared for me to ask some questions, and I really hope that you guys can engage and get involved as well. So today we are going to be going a lot deeper into wave theory and indicators. So you guys would have seen before from last week, the week prior to that as well. I've been speaking a lot about wave theory. What is an impulse wave? What's a corrective wave? Fibonacci, pattern identification, candlestick formation, and all of those things. The reason why I keep speaking about it is because Elliott wave theory or wave theory in itself is going to be your fundamental form of analysis when it comes to trading. So that is why it's going to feel a bit repetitive from time to time, or from every single session. But the whole point of trading, and from what I'm teaching you guys, is for you lot to, one, get it embedded into your minds and your head, and two, for you to be able to repeat that. And the more you continuously repeat it when you're trading, the better you will get. The better you get, the more that increases your win ratio, which in returns puts more money in your pockets. That's what this is all about. I'm sure you guys aren't here just to learn theory. You're here to trade so you can make money. So it's for me to teach you in the best possible way and embed that into your mind. So there's one thing you would have seen me speak about is indicators. So indicators is the first thing we're going to touch on now. Now, with indicators, there's going to be 3 to 4 different indicators that we're going to speak about today. Now, generally speaking, when it does come to indicators, there are hundreds of indicators out there. There's so much. So if you try to use all of them, what's only going to happen is that you're going to end up more confused than being clear. And it's literally just going to just overwhelm you and to a point where you're going to start getting contradicting forms of analysis. So with what I'm going to show you today, a lot of what we're going to be speaking about is one, you understanding the indicators as well as the wave theory, of course, but two, also you guys being able to be strict in how you utilize the indicators whenever you're trading. So there are 2 forms of indicators, right? So we've got a leading indicator. So we've got leading indicators, and then we also have a lagging indicator. So if you look at our leading indicators here, so the leading indicator really tries to perform, it tries to predict and understand the future price action of our moves. So just to make it a bit more clear, let me put up the charts. So it's now time we get into the charts. So actually, let me save the charts for now until we get into our MACD. So the whole purpose of a leading indicator is that it tells you, or it identifies where a move is going to go before it happens. So one of the indicators that I use, which is a leading indicator, is the stochastic. RSI is a bit of a leading indicator as well. But with the stochastic, that helps me to identify points of entries, whether I want to buy it or sell it, before the trend has even been confirmed. Now, with a leading indicator like the stochastic, whereas it predicts where the price might go before it even happens, yes, it's faster, but that also means that it's prone to more false signals, meaning it might show me what might be perceived as a buy or sell, but sometimes because it's identifying it before it's even happened, it might just give you a false signal to a point where it might say sell and it just continues to buy. So it's very important to really just kind of use your leading indicator with a lagging indicator. And of course, like I've always said to you over the last few weeks, use it in conjunction with everything else that you use, i.e., the wave theory, the trend lines, the pattern identification, and the candlestick formations and the Fibonacci tool as well. So there's something very, very important to consider. Now, if we look at a lagging indicator, so what is a lagging indicator? So a lagging indicator is basically the opposite of a leading. So what the lagging indicator does, it basically confirms the trend after it's begun. So what I'm going to show you guys very shortly is is the MACD and the Bollinger Band, which I personally use. You lot don't need to use this. You are going to, I would advise you lot to really try to kind of become comfortable with what you think suits you best. This is what suits me best after trading for over 10 years. But you guys might, a lot of people use RSI. RSI is a very good indicator to use. Myself personally, I don't use that. I use stochastic, which actually combines RSI as a leading indicator. I also use MACD4C, which is a lagging indicator. I only literally use that to confirm the trend and confirm the momentum of the trend that I'm currently in. And from time to time, I use Bollinger Bands. The Bollinger Bands also helps me to identify entry points whenever we're in a correction as well, which of course I'm going to show you. So momentum versus volatility. So the whole point is that the momentum shows you the strength of an RSI or MACD, which in terms of how high it is or how much is coming into overbought or oversold territory. Whereas and it shows you the volatility kind of and the contraction of price as well in terms of the Bollinger Band. So that is the momentum versus the volatility. So momentum shows you the strength, how high it's going to go, how in terms of overbought, oversold, whereas volatility shows you the expansion or the contraction of the price action, how much volume is in the markets. Are we in a corrective are we in a corrective? Is the market behaving in a corrective formation, or is the market behaving in terms of a impulsive sort of behavior? Which is at that point, that's when you start to see the market expand, which is where Bollinger Bands comes into play. So as I mentioned again, I do not use one over the other. I use both of them interchangeably at the same time, and it allows me to be more accurate with my analysis. So I'm going to show the chart now. So what you guys are going to see, I've got three different charts which I'm going to kind of toggle back and forth between. In each of these charts, you guys are going to see, and I'm going to clearly show you exactly where and when these indicators tend to be very good when it comes to trading and allows you to have more of a trader's edge as well. So it's very important for you guys to pay very close attention to this. And again, whilst we're on a call and even you coming off the call, try to put this into practice yourself so you can also try to identify where the moves are coming in and where the moves are coming off. So MACD4C. So MACD4C, that is a lagging indicator. Last week we had a session, and within our session, I briefly showed you exactly why I use the MACD. I use the MACD to confirm the trend. That's the main purpose of me personally, why I use the MACD. So the whole point of the MACD is that it really helps you to understand whether we're in a uptrend and whether that uptrend is coming to an end and whether we're going to go into correction. Once that correction it comes to an end, where is our next move going to take place, whether it may be an uptrend or a downtrend. Now, these are two different variations of the MACD, very different. So this one here is called a MACD4C. So this is what I use, the one on the top here, which confirms the trend. Whereas this here is a normal MACD, which really combines the MAC. It's kind of your default view of a MACD, which helps you to understand the momentum of the price as well as the trends that you're currently in. So I just want any of you guys to put in the chat. You don't even need to unmute your mics for this, but when the MACD is in the green zone, what does that mean? I'd like any one of you to give me an answer to that. When it is in the green zone, what does that mean? Perfect. Yes, 100% buying. So when it's in a red zone, it means we're selling. So the two main things that you need to really bear in mind for the MACD is that when we're going into green, it means we're in a buying territory, meaning an uptrend. When we're going into red, it means we're in a selling territory, a downtrend, or it could be a correction. The MACD helps us to understand the waves. So when you're identifying your trends or you're doing your wave count, the MACD can be very helpful with you understanding what wave you're in. So the reason why I can tell you guys in the USD JPY, which I shared with you lot last week, that I can say, oh, this is one wave here, one wave there, depending on the time frame I'm looking at, is simply because of the MACD. So if you look at this MACD here, we've got one wave up. And the reason why it's one wave up is because, as you can see here, it's green, and here we've got one wave down because it's red. Here it goes to green again, so it means we're in a wave up. And now, as you can see, slowly coming into red territory, and the price has been doing that, which means we're in a wave down again. So that really, for me, is the foundation or the main advantage of being able to use the MACD. Now, the MACD, as I said, is a lagging indicator. So in terms of it identifying a move, I do not use the MACD to help me go into a move before it's happened. I use the MACD to help me confirm that we are in a trend, or to confirm that we are in an uptrend or we're in a downtrend, or whatever it may be, whether it's a correction, whether it's an impulse. So for instance, if I'm using the MACD, for me, once I see it go into red, not red, into green territory, I'm just going to say, oh, the MACD's crossed over. Let me enter, instead of saying let me enter a trade because it's crossed over, I'm going to say, okay, it's crossed over. I see the wave structure that's already been formed, and really and truly it's just confirming the momentum that is currently in. That's literally all it's doing for me. So that's the MACD. So if you're going to use the default MACD, so as I said, this is the one that I use. I'll minimize that. So this is the default one here. So if you're going to use the default one, what's quite good is that it allows you to see exactly when the price also started selling rather than buying. So as you see here, so this is the histogram. So the green is the histogram, red is the histogram. So if you look at I'll share this presentation again. I should be able to share everything on one screen, to be fair. Okay, hopefully you guys can see this here. So the histogram, if you can see here, this is the histogram. The 2 points that cross over is the signal line and the MACD line, which I'm going to go back to the chart on as well and show you as well. Now, when the two parts cross over alongside with the histogram showing us that it's in the up or downtrend, that also gives us additional confirmation that we are either going up or we are going down. So back to the charts again. So if you guys can see here, we've got the histogram that has confirmed that we are in an uptrend. As you can see here, this is the MACD line. So the blue one is the MACD line. The orange one is the signal line. As you can see, when the blue line, the MACD line, crosses below the signal line, that there is an indication that we are going to start going down, if you see it there. So it's always important to look over the crossover lines. So as you can see, when the blue line crosses back over the orange line, that is a signal that we are going to start going up. But because this is a lagging indicator, by the time it crosses over, you've probably already missed the first part of the move, in all honesty with you. So that's why it's more so something that gives you confirmation rather than a trade, rather than a entry point for a trade or an exit point for the trade. If you look here, by the time it crossed over to go up, that is when it crossed over. So we already missed these first two candles here by the time it crossed over. So that means if you're waiting to go into a trade based on the MACD crossing upwards or downwards, you're probably going to not get I wouldn't say you wouldn't get the best of entries, but you're going to be getting in a bit late if you do try to rely on the MACD to get into trades. So always use it as confirmation of a trend rather than an entry or exit. So that's the MACD. Now, the second one we're going to go into is an RSI. So I just want to know from any of you guys, Do any of you know what a RSI is? Feel free to unmute your mics as well. If any of you, or have any of you even used a RSI before? As I said, I know it's very popular. I personally don't use it, but I'd be very interested to hear if any of you guys have ever used the RSI tool. Okay. Okay, cool. Sure. So one thing I will say is give it a try. Definitely give it a try. It is something that a lot of traders tend to use. As I mentioned, I personally don't, but there's nothing wrong with trying out these different forms of analysis. When I start to show you the Bollinger Band, I know a lot of people hate the Bollinger Band. Myself personally, I like it because I've built up a relationship with it, so I understand what I tend to understand what's going to happen in the markets once the Bollinger Band shows me a certain signal. Yeah, relative strength indicator. So definitely try to put it on a couple of your charts so you can become more familiar with it. So in terms of the RSI, basically what it does, it gives you the relative strength from 0 to 100. 0 is when the price is at its bottom, is bottomed out. So literally it's over oversold to the mats. 100, once the price, if the price does go to 100, you know it's been overbought to the mats as well. Meaning the moment you see it go to 100, you know at some point it's going to start coming back down again. So if I show you the chart, I'm going to show you the chart for this. So the stochastic RSI is what I use, but right now we're going to focus on the normal RSI. So this is the normal RSI here. What I want you guys to do is pay very close attention to what happens on the chart whilst I'm also breaking down the RSI as well. So when a RSI, so this is the 50-point line here. You guys can see from my mouse, that is the 50 mid, so that's the midpoint of the RSI. If a price is trading at the 50 point or below it, generally speaking, we are in a downtrend. If it's trading at the 50 midpoint or above it, generally speaking, we are in an uptrend. So if you guys can see here, the price at this point has been trading above the 50% mark. And what has been happening here? We've been in a uptrend. So it just confirms the trend that we are in. If you guys can see here, when we got a sharp down, the price went all the way back down to this point here. And now what you can see is trading in between. It's trading between the down and just above the 50-point mark, meaning we are in a corrective territory as we currently speak. So it's very important to understand what does it mean on your chart when the RSI is trading within a specific point. So if the RSI is trading above, so as I said, if this here is the 70 zone, if it goes to 70 or above, generally speaking, what that means is that you're in a very, very strong uptrend. As you guys can see here, at this point, it was trading above that point. And what can you see here? At that exact same point when it was trading, the price has also been in a very strong uptrend as well. So again, very similar to the MACD, the other side just kind of adds value or gives more confirmation in regards to the trend you're in and the momentum that the trend has picked up as well. So the fact that it was trading within this territory here means that we're in a very strong uptrend. Once the MACD starts trading below the 30 and the 0, that would technically mean, generally speaking, that we are in a very strong downtrend. And once it gets into those territories, a lot of people say, oh, because it's at 88 or 90, let me start selling it. That's the wrong thing to do. By the time, because what can happen once it gets above this zone here, that's when a lot of people call what's called the is it dead man's territory? It's not dead man's territory, but it's basically in very dangerous territory, meaning that it can continue to trade within that point there. So what I would say is that if the MACD comes above the 70 zone or below the 30 zone, don't try to buy it just because you see it down here. Wait for it to come back in to this 70 and this 30 zone here. before you start buying or selling. And if you are going to buy it when it's all the way out of this 30 zone or all the way out of this 70 zone, make sure that you've got very, very strong pattern identification. Make sure you've your Fibonacci tool, your wave theory, your analysis, all of that is giving you reasons for you to go in whilst it's at this very low. But generally speaking, you want it to settle back in within what we like to call the safe area before you do start trading the MACD. But as I said, I don't use it. It's not I only used it for probably about a period of a year before I started going to the stochastic. And for me, the stochastic has done me well. So I've not really found any reason to kind of use any other tools. Now, I just want to ask, have any of you guys who are trading, have you used the stochastic? Just out of curiosity. Or are any of you not familiar with the stochastic indicator? Okay. Cool. Ca- Is there any? I know there's a few traders who are currently in the session now. I would be very interested to know what indicators do any of you guys use and why? Is there any indicators that you guys have felt have done good for you or have actually helped you with your trading that you'd like to kind of put in this chat? I'd be very interested to hear what some of these experienced traders or active traders are currently using at this moment of time. I see no one don't want to share their strategy. Okay, cool. Fair enough, fair enough. So RSI, you guys have all of the cheat sheet for the RSI here. So as I said, it's more of it's a lagging. It does do a bit of leading as well, but it's more of a momentum indicator, and you can use it to identify your trend. The one that I use now is stochastic. So I've been using this for probably about 10 years. It's a leading and it's a momentum indicator. And for me, the reason why I like it is because it helps me to identify when something's going to turn around and good points of where I can enter for a buy or either enter for a sell as well. It is quite sensitive, so sometimes, as I said to you lot, it can be prone to a fake breakout. So I need to make sure that when I am using it, I'm correlating it with my MACD 4C, which is what I showed you, and I'm also correlating it with the impulse and the correction and the pattern identification that I've identified at the time. So does anyone have any questions? Because we've gone over three different indicators. Does anyone really need a bit more clarity on what I've just discussed?
Yeah. Sorry, I
Yeah.
have a question. Um, so just in regards to, when you give me 1 second, let me just go back to my notes, sorry. Um, Obviously, so with the RSI, it says it helps to understand the trends. So can you hear me okay?
Yep, I can hear you.
Okay, cool. Um, what I'm basically just trying to figure out is you mentioned obviously once it goes out of that not to sell or buy, you need to make sure that you're confident in the pattern and make sure it comes back into a safe space. But then at what point do you kind of wait for it to kind of go up again? And then you would like, I don't know if that makes sense, but
Yeah,
it's
it
almost
makes
like
sense.
at what point would you feel confident to say, okay, cool, you know?
So let me bring it up again. So let's just see here, right? So if you look at this point here, right? So this is where it came out of that 70 zone area.
Mm.
Now, at that point in which it came out, what you guys can see here is that if it came out, so at the highest point it was, which was here, if you align that to the trend, that was here at this moment of the trend. A lot of traders, when they see it go to the highest point, they will say, okay, it can't go any higher than that. Let me just sell it. And then if you've done that, obviously you'd be in a very unfortunate predicament because the price went all the way up there, even though it wasn't even going higher. So
Hmm.
what I would say is that once, in order to understand whether you want to buy or sell, if you feel that is really far out of the buy territory or the sell territory, you really want to match it up with your wave count. with your
Hmm.
trend line, and with your pattern identification. So if you go deeper, so let's just say we go into the daily time frame. If you saw that within the uptrend, it broke a specific trend line, let's just say that was the trend line there and it broke it. You also saw that within that trend line that it broke, there was divergence. Remember, going back to our last week's session where we spoke about divergence. Whilst seeing the divergence and the break of our trend line and it doing the retest, as you can see here, at that moment of time, it was also out of that territory again.
Hmm.
The moment it breaks your trend line, and if it's got divergence with the break of your trend line as well, and you know that it's in the fifth wave, then I would say you can go with the sell for the RSI. But you need to make sure you're identifying or you're looking at all of the other moving parts of the chart rather than putting your core focus on the RSI by itself.
Okay.
Cool. I hope that answered your question.
Yeah, no, it does. It does. I'm explaining it better. Thank you.
Okay, no worries. So yes, always I put a lot more emphasis on my price action and then I use the indicators just to give me more confidence and confirmation with the price action that I've put the emphasis on. So stochastic. So for me, as I said to you all, stochastic is my go-to. What Trade and View offer, which is really good, and you can get on Vantage as well. They offer what's called the stochastic RSI, and that's probably why I don't use the RSI as well in hindsight, because stochastic pretty much allows you to kill two birds with one stone. So if you look at here at this point here, so the stochastic, like I said, you've got the fast moving signal and then you've got the delayed one. So the blue line there is the fast moving signal within the stochastic, which is also usually known as the K. So that's the crossover. And then the D white, the orange line is also known as the D, which is the lagging signal. But before going into kind of all the, the semantics and the jargon behind it, what you basically want to do with the stochastic is say, okay, once it goes into overbought or oversold territory, so let's just say this is the overbought territory here. Once you can see that blue line crossing below the orange line, and as I said to you before with the RSI, if you can match it up with everything else on your chart, then you can use that as an additional indicator or confirmation to sell it. If this chart was, let's just say, going up like this here, and this stochastic was only in, let's just say, none of this had ever happened. Ign- Try to visualize this. This never happened at all. So it was only doing this. This is all you could see within the stochastic whilst the price was up there. That would lead me to believe that there is a probability or possibility that this could also continue to keep going up as well. So I always try to make sure that ideally they're all saying the same thing before I even commit myself to a trade. So sometimes you guys may look at a trend line, a break of a trend line, a reversal formation, and you might go in for the buy or the sell. But it's very important to marry everything up with each other, just so you can get that extra layer of confidence, which means that you're not going to be second guessing yourself. You're not going to be pulling out of trades before you're supposed to come out of it, and you're going to be feeling a lot more confident staying in it because you know that everything ticked off in terms of the correlation. So again, with the stochastic, I always like to use it in the same direction of the trend. So remember what I said to you guys, the trend is your friend. So if we are in an uptrend, I wouldn't use the stochastic to sell something if we're in an uptrend. I would more than likely use it to buy something. So now that we're in an uptrend, we've got a one, two, three. The moment we get in another low, I'm now looking at the stochastic and seeing where is a good area for me to buy it. Once, because I know we're in an uptrend, we're getting another low. So I'm now looking for it to go down to potentially these territories. And once the stochastic goes down, and I can see that the blue line is crossing above the orange line. Hopefully, I think guys should be able to see that again. Once the blue line crosses over the orange line, and I can see that it correlates with the corrective pattern that I've identified on this time frame here. I'm now using that as an indication for me to go and buy it. So I always use, so one thing to always bear in mind is whenever you are using your indicators, always try to use it in the direction of your trend. If you are getting involved in a correction, just be aware that it's a correction, meaning you're not going to be in that trade for a long period of time. So, generally speaking, your short-term trades, if you're doing it over a period of 15 minutes or an hour or maybe half a day, generally speaking, you're going to be taking those trades within corrective formations. If you are taking a longer term trend, especially a trade, especially in an uptrend, generally speaking, there should be no reason for you to be coming out in half a day or in 1 day or in 2 days. If you've shown me, if we've identified an uptrend and you've gone in for the buy here, you've had an amazing buy entry, and you can see everything's marrying up. It's all oversold. So the stochastic is pointing it up. You know it's a correction. You know in an uptrend. I really don't want to be hearing anyone in a group chat saying that I've just gone in this amazing trend and I've come out after 2 hours or 3 hours. Why are you coming out for? There's no need for you to come out. And that's a mistake that I always used to make as a trader as well. And then before you know it, you've come out of a trade, you look back in front of your computer and it's gone up another 300-400 points. And then you're kicking yourself saying, why did I come out of the trade? So if you are going in the same direction of a trend, stay in the trade longer. Don't be afraid to ride the wave. Short-term trades for correction, long-term trades for trends. Does that make sense? Is everyone clear with that? Just put up a thumb. All you've got to do is put a thumbs up just to let me know that you're clear with everything that I'm saying. Cool. So that is the stochastic. So I use the stochastic with the MACD 4C. That's all I use. I don't use anything else. I I do use the Bollinger Bands as well, as I said, which is what we're going to go into now. But me personally, MACD to identify and confirm the trend that we're in, stochastic to help me identify potential areas of buys or sells before the trend has even been confirmed. But as I said to you, because it's prone to breakouts, because it identifies things before it's already happened, I need to make sure that I'm using it in the same direction of the trend. Otherwise, it's going to leave me in a pretty bad predicament. And then I use Bollinger Bands as well. So what is Bollinger Band? So the whole point and purpose of a Bollinger Band is to really get me to understand how much volatility do we have going into the markets. So with a Bollinger Band, they tend to work well when you're looking for an entry point within a corrective formation, or when, let's just say, the market is kind of behaving correctively in terms of price action. What happens when it goes into a corrective price action? The Bollinger Bands start to condense. And then what happens once it breaks out and you get your impulse, that's when the Bollinger Bands start to expand. Sorry, one second. So that's when the wait 1 second. Sorry about that. Okay. So Bollinger Bands. Again, guys, all of you, go on your chart. When we're finished, put up these tools and these indicators and just have a feel for it yourself. When you've got the indicators up, ask yourself, what is it doing? What's the price action doing within the indicator? And ask yourself, is it actually respecting what the indicator is saying? So with the Bollinger Band, there's no need to use it in a trending market. So what I use it for is if we're in a correction. So let's go to a correction, for instance. Okay, so there's a couple of different things we're going to speak about here. All right. Okay, I'll tell you one thing, right? One thing that is really good about the Bollinger Band is I find it to be very helpful. is that when if you can see here, this is the top part of the band, and you've got the bottom part of the band. Usually, generally speaking, when the price breaks out of the Bollinger Band, it tends to reverse in the opposite direction. 9 times out of 10 when it breaks out. Can you see every time it's broken out of this Bollinger Band, the price has gone down. It broke out of the Bollinger Band here, the price went down. And when it breaks out on the other side, can you see it broke out at this point? That's the wick, the price has gone up. So what you can generally see is that when the price breaks out of it, that usually results in some sort of short-term reversal. So if you can see here, the price wicked out of that Bollinger Band, it come into unknown territories, and what happened? The price went back down again. So if you can see here, if you do even more identification and formations, the price went out of it. Whenever it goes out, you can see that it goes back in again. So that's just kind of it's a little trick to help you understand, are we going to get some sort of reversal? But if you can see here, the price broke out of it many times. Here, and it still kept going down. So the reason why I'm telling you this is because when the price breaks out of a Bollinger Band, you only want to take it in terms of a reversal in the same direction of a trend. You only want to take it in the same direction of a trend. So if we're in a downtrend and the price breaks out of the Bollinger Band, there's no need for you to try to go in for the reversal because we're in a downtrend. If anything, it's going to keep breaking out, or it's going to keep doing things that's really kind of goes above and beyond the limitations of the Bollinger Band. So you always want to make sure you're identifying what trend are we in, and depending on the trend that we're currently in, how can I identify what it's going to do within the Bollinger Bands once it starts to consolidate. So I'm trying to show you just a brief example here. So this here is a uptrend. As you can see, this is the previous low. So we've gone up, we've done a bit of a correction, we've gone up again. So for me now, where the Bollinger Bands comes into play, I would identify my trend. So I'd say, okay, I've got my pattern identification, which is this. I would also say that we're currently in an uptrend because of the previous lows in which we're coming from. So the more I can see it coming out of the limitations of the Bollinger Band and breaking and spiking through it, the more that's giving me more of an indication that at some point we're going to start going up, or reversal is going to come into play. But the only reason why I'm going to take it for this particular trade, especially what it's doing within the Bollinger Band, is because it's directly aligned with the direction of my trend. So as you can see, once it broke it here, it spiked it. Once it spiked it there, you align it with your pattern identification. You also align it with your wave theory and your trend lines that you can currently see. And what can you see there? Since it's done that, it's gone all the way to the upside. Now, that's the only time I'd use it. So the moment it comes out of it, I'm basically removing my Bollinger Band. There's no reason for me to even be having it visible once it breaks out of it and the trend has continued, because it's now done what I've wanted it to do with the correction that I'm looking at whilst it's trading. So again, you've got a cheat sheet here. When it touches it, it doesn't mean it's a reversal. You need to confirm with everything else, but it is good for identifying breakouts. So it's good for when you're in a correction and you want to identify at what point of that correction could I get even more confirmation that it's now ready to break out of that correction to resume its trend. That's the only reason why any one of you guys should be using a Bollinger Band. Do not use it for when you're trading within an uptrend or a downtrend, only for correction. So in terms of the patterns, well, not the patterns, sorry, the indicators, can you guys let me know, is there any that you don't understand, or is there any that you want a bit more clarity on before we move into the Elliott wave basics?
Sorry, Bentley, you said something about you see when you're analyzing that chart, you went under it and you were talking about like the blue over the orange line. Could you go over that quickly?
Yep.
I
So
did of it, but I was just like, raw, I didn't get enough on it.
so this one here, you're talking about the stochastic RSI.
Yeah, the stochastic, please.
Yeah, sure. Yep. So stochastic, what you're doing in order to confirm your buys and your sells, you
Yeah.
want it to cross over. So when it's in a buy territory, so let's just say it's been overbought, you want the blue line to cross below the orange line. Can you see here? It always crosses inside the orange line. So that's your
Okay.
signal. So once it crosses inside, considering you've matched it up with everything else, that will act as an additional confirmation to sell it.
Okay.
When it's oversold, in order for you to get confirmation to buy, again, you want to make sure you tally it with your trend, make sure it aligns with everything else. But once the blue line crosses inside the orange line, going back up again, then that is your confirmation, again, your additional confirmation to go and buy it once it crosses with inside. So you're always looking for a cross. So for instance, if it's doing this here, it's not crossed over at all.
Okay.
The chances are that it's going to continue in that direction. So
Hmm.
you always wait for the crossover with everything else.
Okay.
Cool.
Yeah,
Perfect.
that makes more sense. Thank you.
Brilliant. Right. We're gonna go. I'm gonna do a quick 3 minute break. When we come back, we're going to go into the Elliott wave theory, and that should take about another 40 minutes, 45 minutes max, and then we'll wrap up from there. So 3 minutes and then back again. Brilliant. We're back. So I hope you guys are all back now, ready to go. Wave theory. So Elliott wave basics. Now, this is really, I would say, without a shadow of the doubt, the most important part of what you guys are going to learn when it comes to trading. This is what you really need to try to grasp and understand. The theory behind wave theory and Elliott waves. Now, I'm not asking you to be able to identify every single squiggle or movement that goes on in the markets. But what I do need each and every one of you to be able to identify is when we're in an impulsive wave move or when we're in a corrective wave. And the sooner you guys can start identifying the difference between an impulse and a correction, is the more you will really it will give you an unbelievable edge in the markets, and it will allow you to identify things and put yourself into trades that other people just haven't seen yet. All of the trades, the trade USD JPY trade that I took, all of that and all of the trades that I've taken in the past, the reason why I've been able to have such a good risk to reward ratio and my hit rate is so high is simply because I've been able to identify waves. So let's really try to hone in on this, really focus on this part of the session because, this is what it's all about. So Elliott waves. So the markets moves within waves, right? So it moves within waves within waves. I've already shown you guys examples a week or so ago. We know that if you go on the daily time frame, I keep talking, but I think it's always best to put up a chart just so it makes more sense for all of you guys watching. So we have waves within waves. So now let's combine everything that I've been talking about today, just to kind of put it all into practice, right? So let's delete all of the lines. All right. Remember, what do I use to confirm my waves? MACD4C. So what I'm going to do, I'm going to go to the tool, MACD4C. This is the initial, so this is one of the first things I do. And this is how I expect all of you lot to trade going forward. So I start off with the monthly. Okay, what is going on in the monthly? What is our structure? What's our biggest overall structure looking like? Okay, cool. This is the monthly. So what's happening here? I can see we've got one big move down here. So that's one. And then I can see we've now got another move back to the upside. So I'm looking at two trends that we've identified. One, two. It's two trends that we can see. So now in my mind, I know that we've had a big downtrend for the USD JPY. And within that trend, as you can see, loads of waves. This is where fractals come into play. You can see loads of moves within that uptrend, within the downtrend, sorry. And now we are in a correction, or it could be an uptrend. I would say it's more of a correction than anything else. So that's the monthly. We've got two waves. I then go to my weekly. And remember the monthly, you can look at your wave count with the MACDs here. So if you look at this MACD, so here to here, you can see one down. That's the MACD in the red zone. Can you see it going back up into the green zone again? So that's up. Red, you can see here is a lot smaller. So the volume is not as high. Because the volume is not as high, that tells us that this is probably a correction once it's done a down. So if that's telling us that it's probably a correction, what are we going to do? We're looking for opportunities to go in for a sell. So that's our correction there. So remember, when it goes, as I said, when there's more height to it, it means that the likelihood is that it's a impulsive move. When there's not as much momentum, as you can see here, the likelihood is that it's a corrective move. So this is how I would have taken the trade in. So that's the correction. One down, one corrective formation forming. Now let's start looking for our sells again. As you can see here, the MACD is starting to go down. So I would have gone in, this would have been my entry right here from this trade. That would have been my entry point. Or if I went down into a smaller time frame, let's just say, because remember, we are looking at the monthly. If I went down into a daily time frame, this move here, there would have been 3 waves. There would have been a multiple waves within that one move. So if I've identified this on a monthly time frame, now my next thing to say is, okay, well, I believe it's going to go down. Let's start looking for entry points. So I'd go into the 4 hour or the 1 hour, I'd identify that trend. And once it breaks the trend, do you know where my entry is going to be? Right there. So I'm actually entering before it's actually broken this bigger corrective formation. And what has it done? As you guys can clearly see, it's gone all the way back down there again. It's done another correction. It's gone back down, down there again. So that is how, I'm just giving you an example as to how I would have taken that particular trade just by identifying the waves that we're currently in. But now let's look at how we can take the trades that's going on today. So right now we are in an uptrend. As we know, we've done the downtrend. We're currently in an uptrend. So this is the monthly. So this is what our monthly is looking like, right? So we've got one move to the up on the monthly. We've got a down, which is corrective, as you can see here. There's nowhere near as much momentum as what you've got in these moves here. So we can clearly see we are in an uptrend as we speak. If you was to take advantage of this, you would have had your trend line, which would have been somewhat like this. And then as you can see there, once you go into your smaller time frames, you'd be able to identify even more patterns and identifications to take the buy, should you have wanted to take the buy. So we are in an uptrend. I'm putting a trend line from here to here because I can clearly see we are in an uptrend. Remember, your trend lines aren't always going to be perfect. Don't think that, oh, I need to try to match the trend line exactly to that point. Sometimes the price may slightly fall below that point in the trend line. But what you want to do, you want to ask yourself, what was the lowest point of the MACD? Where was it at to help me identify where the lowest point of the trend is going to be as well? So we've got my trend line. So right now, well, I can say, let's just say, for example, we've got our wave. We've got our 1, 2, and this could be our 3rd going into our 4th. The reason why I say it could and why it's not that is because the MACD has not gone into red territory. That is why. Once the MACD goes into the red territory, then I can get even more confirmation and say, okay, now this is actually our 4th wave. But since it's not done that yet, we are technically still in the 3rd wave. The only difference is that within this 3rd wave, we could get a 1, 2, 3, 4, 5 wave count within this 3rd wave. And then it goes down to give us the 4th wave. So that's how I'm currently looking at it. So now I've identified, okay, we've done the 1, we've done the 2, we're currently in our 3rd wave. I'm now going into the weekly. Now I'm saying, what is the weekly showing us for this? Okay, cool. So we're now in our weekly. What's happening in our weekly? Again, we're using the MACD 4C. So we've got 1 to the up. What's happened there? It's gone down. 2. We've got our 3, as you can see here. And what's happening within this 3-1? As you can see, this is looking corrective. So what's going to happen here? Now we know that we're in our 3rd wave. 1, 2, 3, we're in our 4th and 5th wave. We now need to go into the daily time frame. So as we go into our daily time frame, we now know, remember, we was in our weekly, so we know this is a correction. We know this is a correction because we was in our weekly time frame. We know that we had the impulse here, we had a pullback here, and we've now into the mid-move here. So we know that whatever happens here, it's always going to be corrective over a very long period of time. So whilst we're now looking at this corrective formation, whatever happens in here, we know that a breakout is due to come at some point. But we're going to trade it again. If we're intraday traders, we're trading it for what it is. So what are we looking at here? So within our correction, we're looking at a wave down, wave up, wave down, and it's currently in our wave up as we speak. Remember, this is the USD JPY trade that I brought last week. So now that we're looking at this formation that we're currently in, what we want to identify is, are we going to go up to break it, or are we going to do another leg down again and do a bigger corrective formation before we go up? The only way we're going to identify is by understanding what the price is going to do in this structure here. This trend is finished. That's done. The reason why it's finished is because, as you can see, it's clearly broken it. We've had our downtrend. Now we're in our uptrend, which is very corrective. So what do we want to identify here? Is it going to go to this point here? Or is it going to foul and going to go back down again? The only way we're going to identify is by asking ourselves, what wave count are we currently in here as we speak? And then this is where it gets even more detailed now. So you're looking at the MACD again. So in the MACD, you've got 1 to the upside, as you can clearly see, it's gone from red to green. You've got a down. From down, you've got a mini correction here. All of this here is corrective, what it's done, but it's still within the uptrend. And then now we've got a little down again, and now it's gone back up again. So from this point onwards, now it's very important for us to start scaling in more, scaling in more, and scaling in more. And the more we continue to scale in, the more we continue to understand what it's doing from a smaller degree. But whilst we understand what it's doing from a smaller degree, we also know what effect it's going to have on a bigger degree. So if this does come back down again, because we know we're in our third wave, we're probably going to anticipate another move back to the upside, simply because we've been scaling in and out from our larger degree going down into our smaller degree. So that is really kind of how you identify waves and you do your Elliott wave theory. Now I'm going to show you a very clean chart, and this here is going to make life, is going to get you to see exactly what I'm talking about, rather than it being as complex as it was for the USD JPY. But within a wave, we're looking at 5 waves. We're looking at 1 impulse, 1 correction, impulse, correction, impulse. Where it's only, every time we're looking at a wave, we're only and always going to get a maximum of 5 waves. You can't get any more than 5 waves in Elliott wave. You can't get 8, you can't get 10, it will only be 5. So that's our 5 waves there. Within our 5 waves, we also want to understand what is happening within our corrective waves, because the corrective waves is where we're going to get involved for the continuation of the third wave. So in this case here, you've got the first wave, which is complete. Now it's done the first wave, you want to identify your correction. So this is your correction here. This is what you're currently identifying. So once you identify your correction, you are now looking to go in for a sell, so it can go into the third wave. Now, when it comes to Elliott wave theory, an impulse has 5 parts, which you saw is the first push. The retracement is the second part, which is the correction. The third part is usually the strongest move of a 5 wave count. So within a 5 wave count, the third part will never be the weakest move. So if you get 1, 2, 3, 4, 5, this third wave here should never be the shortest wave in a 5 wave count. The shortest wave should either be wave 5 or it would either be wave 1. Wave 3 would always never ever be the shortest. So if you're looking at a wave and you're seeing that the wave 3 is the shortest wave out of all of the waves, then the chances are you've not identified a impulsive wave count. You've done it wrong for some reason. So also wave 4 sorry. So as I said, so wave 3 is never the shortest wave. So wave 3 usually is the strongest wave, but it's never ever the weakest wave. And within the wave 4, the wave 4 and wave 5 is usually the shortest because it helps you to identify the end of a trend. So if you look at, and the way you can measure this here is by using your price tool here. So with the price tool, you take it from high to low. This price is showing us that this trend, this one trend here, moved 450 pips. Now, to help us identify if this was actually an impulsive wave, we want to know that this third wave here, because remember you've got 1, 2, 3, 4, 5. It's important that this is not the shortest wave. If that is the shortest wave, then we've done it wrong. So 450 pips was the first wave. We want to take it from the top of the correction to the bottom of the lowest point of the last wave. That moved 604 points. So we know this wave here was longer than this wave here. Now we're looking at the last wave, the fifth wave. We want to also make sure that the fifth wave is not longer than the third wave as well. If you see here, we identify the price point. In terms of the pip ratio, 5 wave only went 450 pips. So what that confirms to us is that this wave here, this third one, was actually the longest wave within that trend, meaning this is actually a certified impulsive wave count. So that's how you can identify waves. Now, I'd say the most important part is to understand to kind of, okay, when can I get involved now? So you've got a correction here. This here would also be another correction here. So this here would be another correction. So once you've identified your correction, you now want to use that as an opportunity to sell. So you've got your first wave, you've got a correction there. You've got your third wave, you've got your correction here. So once you've seen all of this, now your aim and your plan is to get involved for the sell at the break of this correction here. So that's all you need to understand with wave theory. What looks like a wave? What is the shortest wave within a wave count? The shortest wave should never be the third wave. And at what point is the correction now breaking the structure of wave 1 and wave 2 before you get into wave 3? And the moment you identify that, you then take it to continue for the buy, or of course, if it's an uptrend, will you take it for the sell, and if it's an uptrend, you will take it for the buy. So that is essentially how we look at waves. Now, within a correction always works as either a ABC or a WXY. I'm really hoping you guys would have looked at this in your book. I'm not going to go into it into too much detail, because really and truly the whole point of the session is for you to identify the correction and know when to take it. When it comes to the terminology of things, I expect you guys to refer to those PDF books and those sheets that I sent you, and so you can just be a lot more familiar with the terminology, what it means, whether it's a WXY, ABC, a triangular formation, a channel, or some sort of pennant. It's very important for you guys to understand those things. So the market moves in waves. So you've got two types, an impulse and a correction. You've got a 5-wave impulse, which moves in the direction of the trend. And then you've got the 3-wave correction, which retraces apart from the trend. So the correction, as I said, you're only getting a maximum of 2 corrections within an impulsive wave move. And within those 2 corrections, you need to identify how much waves or what sort of pattern are you looking at, and how much moves are you getting within that correction, so you know when it's coming to an end. And the patterns always repeat on every single time frame. So as I showed you guys, when I showed you that very in-depth analysis and example, you will identify in your monthly, you'll then go down into your weekly, then your daily, and that's when you can identify waves within waves, which is what makes it called fractals. And that's when we know the market moves in fractals, of course. So this is, again, it's a cheat sheet for you guys to understand. So when you're looking at a wave 1, so wave 1 is usually the beginning, which a lot of traders don't usually catch. It's usually the big institutional funds or the big hedge firms who are actually catching those waves. With wave 2, by the time you do go into wave 2 would never retrace the whole of wave 1. So if you are looking at wave 1 here, for instance, so if you've got a wave 1 here, if wave 2 has retraced all of wave 1, then of course that's not a correction. So it's invalid. Wave 2 should only retrace, it should only go up to, generally speaking, 61% of wave 1. Wave 2 goes up to. If it goes anything above 61%, then it's probably a correction that you're looking at, not a impulse or an impulsive wave count. Wave 3 is the strongest wave, usually has a lot of volume. The reason why it's the strongest wave is because by the time the corrections happened and people's got involved in that, you've now got a lot more players involved in the markets. You've not just got the hedge funds, the institutions, you've now got the retail traders, everyone else that's now realized that we're actually in an impulsive wave count. So that's generally speaking why wave 3 is usually the strongest wave. Wave 4 never enters within the never enters into wave 1. So if you've got wave 1, you've got your correction, which is 2, you've got your third wave. This is wave 4 here. Wave 4 should never go into the territory of wave 1. So if wave 4 goes into wave 1, then again, it's probably not an impulse. You're probably looking at a bigger structure that's going to form into some sort of corrective formation. So it's very important to understand that. So when you are doing your waves and you are identifying your corrections, if you have this as a rule of thumb, it will help you to understand whether you're looking at an impulse or whether you're just looking at a correction. And again, with the last and fifth, the final fifth wave, that's when you genuinely get a reversal or a bigger correction within the trend that you're looking at. So like I said last week, you're usually going to look at your divergence. You're going to add your MACD with your reversal formation on your pattern. And that's when you're looking to start selling, because now you can see that it's come to an end of a big trend, which means you're now going to start evolving or forming to another bigger wave formation, or you're going to start getting a reversal. So very, very important things to consider. And the golden rules again, wave 2 will never go more than 100% of 1. 3 is never the shortest, and 4 never overlaps wave 1. So always have that and bear that in mind whenever you are looking at your trend. And if we can see here, as you guys can see here, so this is wave 1. This is the lowest point of wave 1. This is wave 4. As you can see, wave 4 never went into the territory of wave 1. It stayed within the below the territory, as you can see from here to here. And then you've got the downtrend again as well. So very important. So do any of you guys please ask me questions? Is there anything that you'd like to understand more, get a bit more clarity on when it comes to the waves and the corrections as well?
Yeah, Bentley, for the three wave corrections, is that saying within the corrective wave, there's going to be three waves in that one big wave?
3 wave corrections. So if you, what are you referring to? This one here.
Yeah, because
So
on the PowerPoint, it said three wave corrections. And I'm just trying to understand that.
wait, one, so I'm just looking. So let's refer back to the PowerPoint. 3 wave corrections. One sec.
It's the one before this one. Yeah, three wave correction, the fourth. Yeah,
Oh, this one here.
yeah,
Yeah, so within a 3 wave correction, a correction generally comes as what is known as an ABC. So if you look in the Elliott wave book, when you get a correction, we usually generally get 3 waves within a corrective formation, which ends out to be a channel or a flag or maybe even a pennant as well. In some cases, you can get a triangle, which will actually give you a 5 wave correction. So this what you're asking now, we're now moving into pattern identification. So if
right.
you've got an impulse and you're looking at this correction here, for instance,
Yeah,
generally speaking, within that correction, you get a 1, 2, 3, generally speaking, before it goes back up again. Now, what can happen, and it is is getting a lot more frequent, you might get a triangle which will be expanding, or a there's 2 forms. So you've got the expanding triangle and you've got the contracting triangle. So within a triangle formation, it usually does this. It squeezes right at the end. So it literally looks like a triangle. And within the triangle, what you're usually getting is a 1, 2, 3, 4, 5. Once it completes the 5th wave within that triangle, then it would go back up again.
got it. Thank you very much.
Nice. And that brings up, it's funny you asked that because that's actually this next slide. So this here is what you would usually get within a corrective wave formation, hence the three-wave structure. So look at your pattern identification book, look at your Elliott wave theory book, because this will make things a lot more clear for all of you guys. So you get three different types of formations. You get a zigzag, which is a three-wave structure, but it's very, very deep. So if you're getting an impulse, a zigzag will go like this, really deep, but it will be a 1, 2, 3. Or you can get a flat, which again is a three-wave structure. So if you've got impulse, that's when you get a flat. It will look something like that, and then it'll be a 1, 2, 3. Or you can get a five-wave structure, which is a triangle, which I just said. Whereas within a triangle, you get a 1, 2, 3, 4, 5. Now, yeah, I'll show you on a shot, of course. So this is a three-wave structure, as you can see here. It's three waves. So we've got one wave up, one wave down. Remember, your trend lines aren't always going to match the trend, and then you've got another wave up again. Three waves. 1, 2, 3. It's broken it, then you'll be going in, of course, for the sell. And they all can look quite different. Some can look like this, some can be flat, literally very, very flat. And I mean, if you look at this here, so this here is also a three-wave structure as well. So you've got a 1, so that's your up, 2, you're down, and this one here, your third. So 1, 2, 3, three-wave structure. But as you can see, I've shown all of you guys three-wave structures, but if you look at the patterns, they look completely different from the other. So it's very important to understand that even though you can, and generally speaking, you get three-wave structures, it doesn't mean it's visually going to look the same as another pattern. So that's why you really need to read up on your pattern identification so you can understand, okay, yep, it's a three-wave structure, but it's creating this sort of pattern or it's creating that sort of pattern. And the moment you understand what pattern is creating, it will then allow you to feel more comfortable or confident in the correction that you're in, which will in return help you to take the trade, whether it's a buy or sell. Okay, and brings us on to our next point. So key guidelines. So always refer to this when you are looking at your waves. So if wave 2 is sharp, the wave 4 will usually be sidelines. So and this refers back to what I said, they're never ever going to look exactly the same. So if you've got one pattern that's really kind of corrected in a very sharp way, let's just say you've identified your first wave and you've got a really sharp pullback, but within that you've got a 1, 2, 3. You're then in your third wave, which you've missed, and you now want to go into your fifth wave. This pattern here will never look like this pattern here. It's always going to look completely different. So don't think that because you've seen one thing form that you're now expecting to see the exact same pattern. It will always show you something different. So bear that in mind. Extension. So often the impulse wave, which is usually 3, stretches longer than the 1.382 fib. So if you guys remember when I showed you the extension fib, generally speaking, if you're looking at a third wave count, if you're looking at your profit taking zones, because you need to know when to take profits, it's not just about going into a trade. You also need to know when to come out of a trade as well. If you've identified this correction and you've gone in here, the third wave, which is this third wave here, will generally speaking go to your 1.382 Fibonacci extension level. So if we go to the Fibonacci extension, this is the first wave here. So this is the third wave. This is the 1.382. That, well, it didn't touch it, as you can see. It didn't actually touch it. It slightly fell away from it. But you always want to have your profit taking levels at the 1.272 or the 1.382. So generally speaking, if you've got into the sell for this correction here or any other trade and you don't know where to take your profits, always put up your Fibonacci extension tool and always aim for the 1272 or the 1382. That's where the third wave genuinely goes. So that's a nice kind of good tip or like a good cheat code for you guys to always refer to. And the truncation. So truncation, we spoke about this a couple of weeks ago. Sometimes wave 5 won't exceed past wave 3. So if you've got wave 1, 2, 3, 4, many times you might get 5 and it might only go to the lowest point of wave 3 and then the trend will reverse from there. So never, just because you've taken, let's just say this correction here and it's broken out of it, don't expect that it's always going to go down to the 27 or the 38. Sometimes it will just go down to the previous low and it will reverse. And when it does do that, it's still a 5 wave count. The only difference is that that's now called a truncation. And truncations, I've showed you last time, a few weeks ago, it can happen from time to time. So please be aware of that. And always draw your trend lines. Again, I've always said to you guys, always draw your trend lines so you can project wave 5. Always understand, what pattern that's being formed at the time as well. And the volume as well. Always know that wave 3 is the strongest, and wave 5, generally speaking, is always going to be the weakest. This here again is what I just spoke to you guys about in terms of the Fibonacci tool. So I'm not going to go deep into this. This is just something for you to refer to as you are taking your trades. And now what we are going to look into is basically understanding how we don't overcomplicate things. So I've literally gone quite deep into Elliott wave theory and kind of identifying your trends, the longest wave, the shortest wave, etc. But what you guys really need to understand is how not to become overwhelmed with everything that I've said to you. So what I'm providing you with here is basically just a reference guide again. What you'll find is that everything in this document is literally for you to refer to. It's not something that's backing up my teaching. It's more so when you're trading, you've got a couple of rules and do's and don'ts, things that you should and shouldn't be doing to make sure you're making the most informed choices when you're taking a trade. So this is how you should always take your trades. Always start off with the wave theory. Look at your wave counts, start from the bigger time frames, go down into your smaller time frames and try to understand where's the impulse, where's the corrections. And then once you've understood the wave you're in, you now need to frame the waves as well. So how am I identifying these waves? What sort of reference points am I using? The reference points are what would be your trend lines, of course. So you're going to use your trend lines, you're going to use your channels to map out the wave to help you to identify if it's broken that trend line. Does that mean now that that correction or that wave is done with, and we're now going into our next impulsive wave? So always use your trend lines for that reason. So always identify your key levels. Always combine your Fibonacci retracement tool with your wave theory and your trend lines. Always make sure you've got your key areas of support and resistance so you can get even more confirmation when it comes to identifying your reversals or your optimal points of entry. And always, again, look at your candlestick formations as well. Sometimes I don't look at candlestick as much as what other people do, but candlesticks do help to some degree. If you see a bullish engulfing candlestick in a trend, in a uptrend or in your correction, and it's hit the bottom of your pattern, then that's, of course, is another good sign or indication that it could potentially still keep going up. And always have a maximum of 2 indicators. As I said to you, I will always only use up to 2 maximum. I wouldn't recommend any of you using anything more than 2. I use the MACD and the stochastic, but for the sake of you lot being able to understand what you feel comfortable with, try to have a play with a few different indicators so you can see what you think is best. And then if you look at my chart's always clean. So if every trade that I've set up, I'll show you again here. So my charts are very, very clean. You never want to overcomplicate it. So this is my chart here. So if you look here, this is the GBP USD. So remember, I told you guys a couple of weeks ago what's going to happen with this trade. And lo and behold, it's been happening. So I've got my long-term analysis. I've got the correction that's currently in. So this is expanding. That's on the weekly. I then go into my daily. I've got one trend line here to show that it's in an uptrend. It's broken it. Now that it's broken it, I'm now looking for this here to be one big corrective formation. And since it goes, and as I continue to scale down again, it just helps me to identify where the impulses are, where the corrections are, and what ways we're currently trading in. So I track it down to even the last hour. And this is how I was set. And remember, if you guys saw 2 weeks ago, the chart was trading here. I said to you guys, this is our first point of reference. And I said to you, if it breaks that, we're now looking at even more sales. And as we look at more sales, we are potentially looking for it to even go all the way down to these lows here. And the reason why I can see this is because I've already seen what's happening on the daily. So on a daily, I can already see this sort of formation forming. 1, 2, 3, 1, 2, 3, 1, 2, 3. Once it forms the 3, because of this trend that I'm seeing, we can either go up or it can potentially go even more down. But that's exactly how I was able to see where this was going to go days before it even done what it done. And you guys, you're all witnesses to that in a group chat. So yeah, that's pretty much it. So this just reinforces again. So in terms of the best traders, when it comes down to trading and trading properly, they don't overcomplicate it. They do not overcomplicate things at all. So you're not going to get paid for complicated charts. You're getting paid for clarity. Your money comes in depending on how clear your trades are, how clear your analysis is. Once you've got and established that, once you've established that simplicity, you just repeat it. Complexity creates doubt, and the more doubt you have, the more you're going to second guess your trades, and the more it's going to result in you losing unnecessary trades. And again, you always just kind of one sec. Yep. Always ask yourself, if you had to explain your trade to somebody, you said, "Oh, tell me what is that going to do? Show me your chart." If you can't explain your trade, then you're overcomplicating it. You should be able to tell anybody, show them your chart and explain what's happening on your chart. And it should be able to make sense from anyone who's looking at your chart. If it doesn't make sense, then generally speaking, your chart is a bit messy. But again, just make sure that it's clean for you and make sure it's allowing you to have the confidence to trade properly. And that is pretty much it. So do any of you guys have any questions based on what I've just said? Everything I've mentioned. Is there anything you want to quickly go over?
Not really for me, but you said you used 2 and you showed us 3. So your 2 would just be dropping out the one of the MACDs, I'm guessing.
Yeah. So I use MACD4C, I use stochastic, and sometimes when we're in a very tight correction, I will put on a Bollinger Band at the time. Once it's giving me a formation or that signal with that, I will take it off straight away. I'll remove that chart. But generally speaking, I've always got, every time you see my charts, you'd always see MACD and stochastic.
Well, and a few weeks ago, you mentioned you don't like really being in trades for a long time if there's not really anything going on. You're kind of trying to see the breakout and get it. But then today you said you like being in long, like long-term trades. How long are you staying in a trade on average? A whole week?
It depends. So it depends on the move. So if it depends on the chart we're looking at. So if we're looking at a chart and I can see that it's corrective, I'll probably go in that trade for maybe an hour, a couple of hours, if that, or half a day. So if we're looking at a trending market and I've identified a massive uptrend and I've got in at a time of a correction within that trend, and that correction dictates that it's going to continue to go high again, I'll probably stay in that trade going up to weeks, amount of weeks, and I will come out when it's time to come out. I will if I get to 500 points, that's not going to be my reason to coming out. I used to do that before. I used to say, oh, I've now hit 200 points. I'm happy with that money. Let me come out and take it. But then I'd look at the chart again a week later and it's gone up another 500 points. So for me and for you guys, what I'd always advise is that don't look at the money, don't look at the fact that you've got 100 points or 200 points. Look at the fact that you can see divergence forming, you can see it's broken your trend line, you've gone on a smaller time frame, and it's hit your Fibonacci extension tool. Okay, therefore that's a reason for me to come out of the trade.
Okay.
Yeah,
Hard, easier said than done.
yeah, it's a lot easier said than done. It's a lot, and that is why the community is here. And one thing I would highly advise is for everybody to get more involved in the chats, because when I was trading by myself, I wasn't in a community. So if psychologically I saw myself make 500 points, I may not have had that level of psychological discipline to stay in that trade because I saw the money and I thought, let me just take the money, profit is profit. But when you're in a community and you've got people of different levels kind of saying, this is what I see, it makes you feel more confident with saying, let me trade properly and stick to the analysis that I saw in the first place. So, I mean, there's some traders who trade in silo, but in my personal opinion, the times where I've traded my best is when I've been a part of a community of people who we can actually bounce off and we can confirm each other's analysis.
Cool.
Yeah. So yeah, just I say the main thing to bear in mind is that different instruments is going to make you trade in different ways. So if you might trade GBP USD, that when it comes to trends, you can genuinely stay in that trade for days. But then you might go and trade, I don't know, let's just say Aussie dollar. That might be a corrective environment. So you only might find yourself staying in those sort of trades for a matter of an hour, 2 hours. But it's all boils down to what you are comfortable with. Some people here, some of you might like to be scalpers. I personally I don't like scalping. I prefer to see something that I know is going to give me the best probability of taking away at least a couple of 100 points rather than taking away 10 points or 20 points. But that's my personal preference. There is no right or wrong. It all boils down to what sort of mindset that you have as a trader in comparison to me. So yeah, I'd say that's all. I mean, so I know a lot of good content. Yeah, I will be sharing the slide deck after as well. And again, refer to that, and then we just keep moving from there. So also another very important thing that we're going to do is every Wednesday, I'm going to start doing a midweek market review. So I've not confirmed the time. I'm probably thinking like around 7 o'clock or 8 o'clock. I'll share a Zoom link. I'm not going to be teaching like what I'm doing now. I'm literally just going to be going through loads of different charts in the markets. So I'll be going over wherever I see any good opportunities, we'll be looking into it. And that's use lots of opportunity to one, understand and actually trade in real time because we're going over what's happening. And two, if you want to take advantage of a trade on your demo account on Vantage, feel free to take advantage of a trade on your demo account. And I'm also doing the challenge as well, where I'm showing you guys how to take your trading account from 1K to a minimum of 3K in 12 months as well. So yeah, I'd say come if you want to pick this up quicker, jump on the Wednesday calls. Let's get involved and just do some analysis with each other. And that way that will help you to grasp everything quicker.